Appreciate that. It's always so very warm to hear someone talk about you. And I forget that I was homeless sometimes. So when I hear that, it's like, yeah, those were tough times, but I was really, really young, and I think too naive to really realize what was happening. Being a parent today, I realize how interesting it would have been to be an 18-year-old. If my 18-year-old daughter was living in her car, I'd probably be devastated. But it really did build a lot of character and grit, and I'm so grateful for that today. In that moment, I definitely was not, but today I'm very grateful. I'm going to go ahead and share my screen. We have a lot of information to cover. I'm going to go through it relatively quickly. And the reason is because I want to be respectful of your time. And this workshop does end at 6 p.m. And I also want to leave enough time at the end for questions. There will be portions of the presentation that ask for your participation. If you can go ahead and answer in the chat, that would be great. And at the very end, we'll allow for questions. So take note and we'll go through them. So like Gabrielle said, my name is Sarah Santana. I work for Pacific Premier Bank here in downtown San Luis Obispo. I will provide my email and phone number at the very end. So if a question doesn't get answered for you, or if you have any additional questions, you can feel free to either walk into my branch or shoot me an email. And without further ado, let's get started. Here's a little bit about the agenda. We're going to cover some learning objectives, financial management. We're going to talk about everyone's favorite B word, budgeting. We're going to talk about bookkeeping, financial statements, business financing, and then some key points at the end. I'm going to integrate a lot of my own personal experience in here so you can get an idea that I'm just not going to read the presentation. I want to make sure that you know. I've also been a business owner. I'm actually in the process of developing my 4th business in my career. And it's not to sell. It's probably going to be my lifelong legacy is my next business. I'm planning on leaving that to my daughter. So I'm really excited to be launching that this year. And I'll share a little bit about that at another time. But just know that I love being an entrepreneur and I love the entrepreneur's crazy spirit. And I'm here to not only encourage you, but to educate you on all the information that I know and all the missteps that I've done. For 23 years, I used to introduce myself as, hi, my name is Sarah Santana. I teach business owners. I teach smart business owners how not to do stupid things. Because if we don't know what we don't know, we end up misstepping and then hurting ourselves. So I really appreciate that MCSE does things like this to be able to educate and share information at relatively no cost. So we're going to talk a lot about financial management. We're going to talk about you as the business owner, some practices, some tools that you may use. And I'm also going to open it up to you to share with us what tools you have used in financial management that have been helpful or not so helpful. Okay. We're going to talk about startup financing, how to finance your business, how to get working capital, and financing fixed assets. There should have been a participant's a workbook. Unfortunately, somehow it disappeared on us. So what I'm going to do is I'm going to end up sending that to you after the fact, and you can be able to go through the presentation again that way. Okay. But if you have any questions, definitely feel free to hold those till the very end. But there is a participant's workbook that's supposed to go with this topic, and we'll get that to you. I'll get to you by tomorrow. So you'll be able to review that later. All right. What are some of the benefits of financial management? I think one of the hardest things to work with is money for a lot of reasons. The culture today has gone very far away from the actual dollar bill and cash to online wires, electric payments, Venmo, debit card, credit card, lines of credit. They even came out with the new Monopoly game that no longer has real dollar money. It has this like card debit version of Monopoly. And not only does that take away the fun of counting money, it also takes away the feeling of spending. And so I think that's a big component of financial management is if you have a $100 bill in your pocket, sometimes you hold on to that longer than you would to swipe your card. And I think that's really important to recognize that the culture has changed from 50 years ago where we were using cash and checks to today where we're using debit and Venmo and other electronic forms of payments, especially here in the bank. So let's talk about financial management and how you can reach some goals. And we're going to talk about knowing your profitability, how to forecast growth, how to diversify, and then how to prepare for loans. There is a whole lending section, but I might spend a little bit more time on that because as a new business, having capital and access to that is really, really important. Budgeting, it's probably my favorite B word. And the reason is nobody likes to do it. It's extremely necessary, but nobody likes it. It's kind of like eating broccoli, right? Some people don't like it, but you know it's good for you, so you kind of put it down. It's kind of like budgeting. I think if folks spend 10 minutes a day, 15 minutes, 20 minutes max budgeting, as a business owner, you will save yourself hours of headaches and thousands of dollars in CPA fees for a couple reasons. If you use a budgeting software such as QuickBooks or Quicken or any of those types of budgeting softwares, you can literally log into it for 10 minutes a day, check some of the sales from the prior day, check some of the expenses that went out from the prior day, and consistently keep on top of your finances. As a business owner, we wear a lot of hats, right? Not only are we the janitor, but we're also the sales manager. We're the CEO, and we're scrubbing toilets, right? At least that was me in my business. I wore all the hats, and budgeting is probably the most challenging for most businesses. They understand their product, they understand how to sell it, they understand how to do, whether if you're like a masseuse, you know how to give massages, but no one gave you a lesson on QuickBooks, right? But you're a business owner, it's something that's really, really important to get. And I know that MCSE has a lot of workshops where they can teach you that as well. We're not going to go over too much of the in-depth, but what I do want to make sure that you understand is if you're able to spend very little amount of time, say 10 to 15 minutes a day, budgeting and looking at your prior sales and future projections and expenses, then it's going to make your life a lot easier. And you'll always have your finger of the pulse of your business, because my understanding is if you're not growing, you're dying. And so if your business isn't growing, isn't moving forward, it's kind of dying. And we don't want to do that. We don't want to let our business die on the vine because we spend so much time, effort, and planning to be able to build something and give love to it, just to not really care for it. And I think the financing is where we get pinched the hardest, where we just don't budget. And it could have been a simple 10-minute a day thing. So I might beat a dead horse with that, but definitely take a look at your budgeting. If you're using an Excel spreadsheet, I highly encourage you to use an electronic software instead of an Excel spreadsheet. I used Excel spreadsheets for years and years and years. And when I finally got into using QuickBooks, it made my life so much easier. So much easier. So I highly encourage you to budget. Okay. A couple of things when you start to budget is you need to review each category, right? There's going to be different categories in your business, such as a marketing piece, right? There's going to be a marketing piece in your budget, and then you need to give it a number, kind of an idea. How do you plan on marketing your business? Decipher for your own business the different categories that you may need: sales, expenses, employees, paying yourself, and tracking those monthly expenses. And one of the questions here is, if so, how does this help with your business decision? I think it's important to have relationships with a CPA, with an attorney, with a banker, with a financial advisor, to be able to have a team in place working for you. Now, not everyone can say, hey, I can't have all those people, I can't afford it. But the reality is you don't have to pay me, right? I'm a banker and I can give you a lot of feedback on some of the tracking of expenses, where if you hire a CPA, they may charge you, $250 an hour, $350 an hour. So use a lot of the resources that MCSE has for free to be able to move your business forward. Another important component in budgeting is bookkeeping. They're a critical component of financial management and tracking all your expenses. Bookkeeping will allow you to go back in time to review expenses and will allow you to project forward. On the basis of financial management, when you start looking at your forecasting and bookkeeping, what's important is that you understand some of the expenses and just kind of get an idea of what those may be like. I'm not really familiar with where you are in your business, whether you've been in the business 10 years or 1 year. I recognize that when I was in business 1 year, I was still trying to figure things out. right? I was still trying to figuring out what my marketing budget would be. I was still trying to figure out what my sales were going to look like. I was still trying to figure out what my rent was going to be like. And then COVID hit and everything changed, right? We had to pivot quickly, as most business owners do so well, which is, I feel like, why people get into the business in the first place, is because they're so great at pivoting. I know Gabrielle and I had a discussion earlier about how entrepreneurs are just a little crazy. And I said, I kind of like that crazy. I feel like I fall into that bucket as well as an entrepreneur. So let's talk a little bit about bookkeeping. Here are 10 basic bookkeeping steps, which we just discussed. Obtain a business accounting software. It's really simple. You can just go to Google and Google business accounting software, or best business accounting software for X business. Now, QuickBooks may not necessarily work for you. I work with a lot of gyms in town, and those specific gyms use a very more of a proprietary software specifically designed for gyms, or specifically prepared for folks in construction or agriculture. There are bookkeeping softwares that are designed specifically for your industry that might be a lot better, probably cost a little bit more money, but just know that exists, and you can really simply just go into Google. Business accounting softwares, you can do accounting softwares for a gym, and you will find all the ones that are very specific for you and your industry and business. We definitely recommend that you open a separate business checking account, that you reconcile your checking account, track sales, and deposit your sales. The nice thing about your bookkeeping software is it'll track all of that for you if you have it set up through your bank, where it just downloads at night. The reason I say you only need to spend 10 minutes reviewing is because overnight it will download, and the next morning all you have to do is review it. That's why it only takes 10 minutes. Some of the things may not download properly, right? Depending on your software, how often you do it. You may have opened up a business account and not set it up to download automatically. I highly encourage you to look into how to have it download for you from your banking institution. All the banks do it now, where you can set up the business checking account and it will automatically download the information at the end of the night into QuickBooks or Quicken or any other software that you may have. Writing business checks for your business will also be tracked. Obtaining a separate business card is important to track expenses for a couple reasons. Mostly you just want to keep the IRS out of your business, right? I think the biggest challenge for a lot of folks right now is fraud and the IRS. Obtaining a separate business credit card will allow you to track expenses just for your business and not for any of your personal things. What's really nice as a business owner is almost everything becomes a deduction. Your mileage, your purchases that you use, your advertising, your marketing, your travel, your education. So it's really smart to use a business credit card, not necessarily to use as debt, but to track and to also incur points. A lot of people use those things as leverage. So not only do you get a credit card, but hey, you get points too that you can use for other things. So do your homework as well. You can very simply go to Google and look up business credit card. There are credit cards that exist from very low interest rates to very high interest rates and annual fees. Some don't have annual fees. I'm a big fan of Costco, so I'm a big fan of the Costco City Card. It has an annual fee, but you make it up because at Costco, they give you all that money back, right? It tracks your purchases over time. And at the end of the year, they send you a check and it more than offsets your annual fee. So I'm a big fan of their business card. Pay your business expenses first. Generate and use a P&L statement. So a profit and loss statement you can generate automatically through QuickBooks. You don't have to be an accountant to do that. It's just a tab that says please run, and you'll be able to see a profit and loss statement. And then also it's really important to pay yourself with an owner draw. The tracking is so much easier and cleaner. And if you ever do become audited by the IRS, they want to see that clean transactions. So these are just a few ways to keep yourself out of the IRS's nose and to also keep your business in a place where you want to be financially savvy and financially successful to grow your practice over time. We talked a little bit about financial management software. We talked about financial statements that a lot of the softwares will do for you, but these are the most important statements that you need to know of. There are so many financial statements that you can pull, but these are the top 3 that banks will request from you when you need a loan. a balance sheet, a cash flow projection, and a profit and loss statement. A balance sheet is going to show a lot of information, and then it's going to break it down in the cash flow projections and in the P&L statement. For cash flow projections, some banks don't lend on assets. For example, as a consumer, I can go out and get a mortgage loan with 5% down. It doesn't work like that on the commercial side. You can't buy a commercial building with 5% down. And if you do, it's going to be hard money where the rates might be 12 to 20% or even higher. So if you want to get a good rate from a local bank, the best thing to do is to make sure you understand how to pull these reports and what they mean. If you're unfamiliar with these specific reports, or if you know how to pull them, but you don't really know how to read them, we can talk about that one-on-one if you'd like. And I don't charge for my time because I work for the bank. So the bank pays me to help you. So if these are some statements that you're able to pull, but you're just unfamiliar with how to read them, I'm more than willing to help you understand how the money is flowing through your business. Cash flow projections are really, really important for one reason. Some banks don't lend on assets. They'll only lend on your cash flow. So what that means is they're going to look at your business and see if you can not only make the payment, but you can make the payment twice or 3 times, right? Commercial lending is a lot more restrictive than consumer lending. Consumer lending looks at your FICO scores, your income, and your payment history. Commercial lending will look at your cash flow, your balance sheet, and your P&L statement. Yes, we will pull your FICO. Yes, we will look at the property that you may be buying. But the reality is if these 3 buckets aren't filled, it doesn't matter if you're putting 90% down, right? If your business is losing money and it's not cash flowing, it doesn't matter that you're putting 90% down. You could be buying $1 million building and have 900,000 to put down and only need 100,000. And if you don't cash flow, we will tell you no. It's not that way on the consumer side. As a consumer, if you got a residential loan and you had 90% down, there's not a single bank that would not give you the money. They will all lend you the money and they will be begging for your business. On the commercial side, cash flow projections are extremely important. Financial statements and balance sheets. So I'm not going to go through all of this because you don't have the participant worksheet, but once you have it, if you'd like, we can go through it. Oh, this is a good slide for you to take a look at. You can see it. It's not too small, is it? It's pretty clear on my end. So if it's too small, just put it in the chat that I can make a little bit bigger. But one of the nice things that you can look at is these reports are pulled automatically. You just run it through QuickBooks and it'll have everything broken down for you. Cash and receivables. So account receivables is folks paying you. What you have in inventory, prepaid expenses. If you have inventory that you've purchased ahead of time, it'll be up here, but any prepaid expenses will be down below. Fixed assets are going to be considered like the building that you're in, or if you have a tractor that you need to buy, something along those lines falls into that. Land, buildings, machinery, any equipment, that's all going to fall under fixed assets. And then it's all compiled here. Then it's added together for your total assets. All your liabilities will be listed before, and then the owner equity at the bottom. What does that even mean? All that means is this is worth, can you see, is my mouse showing up, Gabrielle?
Yes, your mouse is definitely showing.
See the mouse? Okay, good. Thank you. This portion of the balance sheet is money coming in. This portion of the balance sheet is money coming out. Assets, money coming in, or items of value like a piece of machinery, a tractor, or a piece of property. All considered positive numbers. Liabilities are going to be the debit side. And then your owner equity is what your company is quote unquote worth if you were to see the value at this one moment in time. Okay. Doesn't mean that's what your business is worth over long periods of time. It just means what it's worth today. So you will know how much of your owner equity that you have. If you decided to set up a S Corp, then that would be the portion of the value if divided by the shares. So for example, if you set up an S Corp and you're a gym and you decided to have your S Corp be only 1,000 shares, what you would do is you would take this 165 number and divide it by 1,000 shares, and you'll know what your equity per share price is for your business. It's good to know that if in the future you decide you want investors, or you want to do kind of a Shark Tank type thing and say, hey, this is what my business is worth. You know, can you lend me 100,000? I'll give you 200 shares of my company. This is what it's worth today in exchange for this loan and your background, right? Give me a thumbs up if you've seen Shark Tank and you know what I'm talking about in the chat. Yeah, some of you know what I'm talking about. Okay, good. If you can't do it in the chat, just a thumbs up in your photo is great. I saw you. Thank you. Cash flow. What is cash flow? There are two primary definitions. The balance of cash received less the amount of cash paid over a period of time. Moving cash in or out of a business. This is, I think, something that you should be really cautious about, moving cash in and out of a business, because it shows in your cash flow projections. So for example, let's say you make a $100,000 sale and you pay yourself 50,000 of that. And then you pay yourself another 50,000 of that. Even though you have the 100,000 in your personal business, or I'm sorry, in your consumer account, in your personal checking account, your business is now worth $0 and nobody's going to lend you money. A lot of CPAs recommend that you take cash out of your business and put it in your personal accounts to avoid taxes. And that's great, but you are also going to avoid all banks as well. Because if you deduct everything to not have to pay the IRS, guess what? Now you look like your business doesn't make any money and no one's going to lend you any money. Now, it's not an issue if you don't need a loan, but if your business needs a loan for commercial lending, we go back 3 years, not one, we go back 3 years. So we want to see your cash flow for not just the last year, but 2 years prior to that. So we want to see cash flow for 3 years. And if businesses keep moving money from their business to their personal account, business to their personal account, business to their personal account to continue to avoid the IRS taxes, you're not going to be able to get a loan. And you can't just move the money back, right? Because when it goes out, it's a payment. When it goes in, it's considered inflow that you may have to pay taxes on that. Then you might have to pay taxes on it twice. So you really don't want to be commingling money back and forth. You want to pay yourself a set amount or a set percentage so it's easy to track and easier to get financing if you decide to get, if you want to buy a building or any equipment in the future. It'll make the process a lot easier. And I'm sharing this with you because it becomes really, really challenging when you have a winery sit in front of you and they have all these beautiful projections and they got $1 million sitting in their personal account, but their business has $40,000. It looks like the business is worth nothing and you're worth a ton of money, which is great, but not if you want to get a loan. So it becomes really challenging at that point. And there's not really much we can do at that point. So just be really smart when you're moving money in and out of your business. Make sure that it's money out for a legitimate expense and that it's coming in as a legitimate sale. Now, if you're taking on a loan and you're making a deposit, QuickBooks or one of your softwares may download it as a sale. You want to make sure, this is why I say you want to look at your QuickBooks and your software at least 10 minutes a day, because if you make a deposit like that and it's a loan, say you get a, $10,000 loan from someone, you don't want to just drop that in your bank account and forget about it. What you want to do is you want to make sure that QuickBooks recognizes that as a loan and not a deposit from a sale, because the tax ramifications are going to be very different on those two transactions. One is a loan and the other one is a sale. You want to make sure you notate that. Financial statements using assumptions to forecast. So this is really, really nice for when you're looking at getting a loan. We can kind of future project of what your sales have been over the last 3 years and take a look at where you're going forward. In the market today, April 13th, 2023, can be really, really challenging because I don't know if you've heard, but there was a bank up in the Bay Area that went BK. It didn't have, it was over leveraged and they had to close their doors. Something similar happened in 2008. If you remember, the market crashed, they were over leveraged. The reason I share these stories with you is because it's so important to keep track of the money going in and out of your business. And for lending purposes, we can future project what the business is going to be like. So today, the industry is very different than the industry, say, 5 years ago. Rates in the last year have tripled. Give me a thumbs up if you knew that. When interest rates go up, it just makes the lending process much, much harder, because if you are getting a loan, say at 4%, today that loan may be 7%. So whatever your payment was, say your rate was, just for simple math, say your interest rate was 3.5. Today, if you were going to get that same loan, it's probably 7%. So it doubled. That means if you had a $2,000 payment for a building, a commercial building that you purchased, or a warehouse, or a gym, or some land to build a winery, your payment just doubled. Your payment went from $2,000 to $4,000. And I don't know about you, but I don't want my payment to double in a year, right? I can't double my sales in a year. I mean, I could, right? It's possible, you could, but you just doubled your expenses as well. So it's really, really smart to not only be aware of your cash flow, but be aware of what the lending side is like for any future business. Some people want to bootstrap their entire business. They dump 401k money, they dump, say, bonuses, savings account, take out an equity loan. They do all these things to start their business. And the reason I want to make sure that this is super clear is because interest rates on some things are variable. And credit card rates are considered a variable rate. It changes every month. Interest rate on a revolving line of credit is a variable rate. So if you were able to borrow money at 3.5, you're borrowing that exact same money at 7%. You're going to function differently as a business owner when it's much more expensive to borrow money. And then I would hate to have you force job cuts or payment cuts or cutting marketing or all the things that are really important to your business because we didn't future project outflows and inflows. And interest rate is a component of that. It's not just sales going in and expenses going out. It's whatever interest rate you're using if you're borrowing money. So that component is really important to pay attention. And I don't think business owners pay attention to that variable rate because we've been so spoiled. As the consumer, as businesses, we've had really low interest rates since when? 9/11? Way back when? So 20 plus years of low interest rates. Most folks today have sticker shock when they realize what rates are. Complete sticker shock. Like, what do you mean it's not 3 or 4% anymore? What do you mean it's 6, 7, 8% now? And in some instances, it can go into the 9 or 10% range if your down payment isn't enough. It can get really, it's just not financially savvy to put yourself in that position long term. So just make sure that you keep an eye on interest rates if you are looking to get a loan or if you currently have a loan and you have a variable rate. It's a big part of cash flow. Oh, I think I skipped 2 slides. Let's see here. Oh, no, I didn't. Okay. How can you, let's see here. How can a cash flow projection help? When do I need one? I think business owners know this kind of stuff already, but I'm just going to go through it really quick. Set sales and expense goals. And I think that's pretty common for a lot of business owners. They have an idea of what their sales are for the month. But if you don't, it's a good idea to sit down and figure out, how do I achieve my sales? How do I track them? How can I get more of them? What works and what doesn't? So setting those sales goals is important, but not just setting the goal, understanding how you achieve that goal as well. Because what's the point of me saying I want to lose 10 pounds if I'm not going to actually make a plan, right? What's the point of saying, hey, I'm going to become a realtor and not have like a real objective below that? So set the expectation for yourself is what is my sales goal and how am I going to achieve it? A good way to achieve that is really just to look at the past. How did I achieve them in the past? Was it referral based? Was it marketing? Did I advertise? Did I put it in the paper? Did I buy ads on Instagram or Facebook? Do I have influencers? How is it that I'm able to promote my business? I'll give you one example. I work with a boutique in Bakersfield. They are a very specialized boutique. They only make products that are faith-based. So faith-based products, sweaters that have scriptures, journals that have scriptures and images that are very biblically based. And their sales had gone down. I asked her, well, how do you do your sales? Like what's the sales process? Do you just post online? Do you word of mouth? What is it that you're doing to let people know that you have a business so that people can buy these products from you? She said, well, I used to get a lot of Instagram sales, but I don't get any anymore. And I'm not sure if it's because the algorithm changed or what may be, but we ended up meeting and having a very nice conversation about using influencers. See, people think that influencers cost money, and they don't. They just get a discount to buy your stuff and to promote it all over town. She didn't realize that. And so now she has influencers all over the country that she was able to identify on her own through Instagram, folks that had enough followers, folks that had a reputation that was good online, and partnered with them to give them 20 to 30% off, and even more so, depending on their sales goals. So if an influencer said, oh, I could probably do $5,000 in sales, she would have this staircase of commissions for them that came after they were able to sell $5,000 worth of stuff. So it actually didn't cost her any money. It cost her $0 to do that. How? She didn't pay them to do it. She just gave them a discount. Now, if you're a sweater company and you sell sweaters for $50, and the sweater costs you $20 to make, we got that $30 margin. But how much of that $30 margin is picked up by expenses like marketing, like employees? Like what else does it cost to make the sweater? Electricity, power, you might need internet access. All these things cost money. The influencer didn't cost any money. They want to talk about the product. They want to share, and they just get a discount, which is great. So just a little idea on how not only just to set the sale, but to below that be able to identify how you're going to achieve that sale. Determine the break-even point. I think a lot of folks don't realize what this is. Determining your breaking-even point is how much money have you put into your business and how long is it going to take you to recoup, right? That's very important for an investor or a bank lending you money. Where is your break-even point? And you don't want to like skim right above the break-even point, right? You want to be well above the break-even point, because if you're not, you're probably not paying yourself. And we want to make sure that we're paying ourselves when we own a business. Planning equipment purchases or replacement for expansion, we are going to look at cash flow projections for that. And then also determine cash needs to purchase and inventory cycles. So most of you heard my alarm go off. The reason I set that timer is because I wanted to see if I could get through as much of this as possible so I could open it up for questions. How are you guys doing on time? You want me to keep going? You want me to open up for questions? Keep going?
I believe you should keep going.
Keep going. Okay. We talked about cash flow. I think we've beaten cash flow to death already.
And we did have a comment from another attendee, Emily Hay, that says, keep going. This is great.
Okay, wonderful. Thank you.
You're
All right, the next section. So we talked about budgeting, we talked about bookkeeping, we talked about balance sheet, we talked about cash flow, and the last one is profit and loss. Your P&L statement, profit and loss statement, also referred as P&L. It measures revenue and expenses over a period of time. So what that means is typically 12 months. We want to see your P&L for a multitude of timeframes. We want to see your P&L statement year to date. What have you done from January to April? We want to see your P&L, what you've done in the last 12 months, April to April. We want to see your P&L from January 2022 all the way through December 2022. And then we want you to run that for the following 2 years. What that lets us know is how disciplined the business has become because it's able to operate like clockwork. And I know as a business owner, I think that's the goal for all of us is we want our business to operate on clockwork. We want it to work automatically. We want sales to come in automatically. We want expenses to come in automatically because all of that takes time. And once you really can capture the revenue and expenses over a period of time, you'll know where you're at. You'll know if you even need a loan or not. And one of the things that we had a conversation with one of our a client recently is, their business had a ton of expenses over the last few years because they were developing a new way to do eye surgery. So there's this new development in eye surgery, but that business hasn't made any money. Is it an amazing concept? Absolutely. Will it work? Maybe. We don't have any revenue to measure, but what we can measure is how that specific eye doctor has run that optometrist has run their practice for the last 20 years. And we could look at the P&L statements for all that time frame and kind of get an idea of what their new business is going to be like. So just know that if you are branching out or developing a new product, there's not really a lot of loans from a bank's perspective for that. There may be through like SBA or other programs, but definitely from the banking perspective, we want to see profitability. We want to see that you can make the payments and that you can pay us back because we are taking on that risk, giving a business money. We want to make sure that the business is able to pay us back, and understanding your P&L is super important. And especially because you want to measure, you want to have an idea of where you're at now and for the last year and years prior to that. The P&L statement, income statement, shows how successful the buying and selling process has been. I can look at a P&L and the first thing that comes out of my mouth is, do you have a sales process? Most businesses will say, no, we don't have a sales process. We have a training program, and then we hire people that are friendly and they like to, talk about our product. The P&L and income statement will show how successful that really is. And having a sales process, from my perspective, is I think one of the most important aspects of a business. I've looked at thousands of businesses, and the ones that are most successful have a process. They have a standard operating process for anything. And my inside joke is always, can a monkey do it? If a monkey can do it, you're good. Because as a salesperson, or as a business owner, you want to make sure that you're consistently growing. How do we do that? With a process. And this will show how successful your process is. It's kind of like where the rubber meets the road. You don't want to look at that, but it's probably the most important thing to look at is my process working? You'll be able to measure the ability of your business to grow, to repay debt, and how long that business can support you. The P&L is the most important report for your accounting software program. So those three things are really the most important, okay? Some of you may or may not know this formula. We're gonna get some cool math in here, but a lot of the software will do it for you. But if you had to do it manually, it's sales minus the cost of goods sold equal gross profit minus profitability is going to be your net profit. If you want to take a picture of that or screenshot that, if you're on a phone, it's kind of fun to play with, or maybe only a banker would say that, oh, it's so fun to do math. Yeah, only me. But I would screenshot that and kind of play with your numbers later just to kind of get an idea of where you're at. What's the basic formula for profit and loss statements? Net profit pays for you, if you're a sole proprietor, any future expansion and equipment, any principal loan repayments, and of course, our favorite people, the IRS. How do I compile a profit? We literally just said that. So we're going to kind of burn through here so we can make sure we cover all of it. Okay, let's talk about business financing. How many of us on this, I want to make sure that we don't cover this if it's not relevant to some of the folks on the WebEx or on the Zoom call today. Is getting financing a goal of yours in the next 5 years? Give me a thumbs up. Awesome, we're going to cover it. What is business financing? I think I covered it a little bit. Understanding those 3 reports in your financial statements, understanding those, make sure you're profitable. And in addition to that, understanding your own personal FICO score and your personal assets. There are 2 ways. I'm going to kind of detour a little bit from the PowerPoint and just talk from experience. When you come to a bank and you need financing, we need to make sure that you've been in business at least 2 years, which is interesting because we need the last 3 years of financing. But we want to make sure you've been in business at least 2 years, because there are smaller lending programs that will allow for that 2-year mark. And we want to make sure that you're consistent, right, for that 2-year period. The quickest way to show consistency is to make sure that you understand your numbers. I know it doesn't sound sexy, especially if you have a cool business like, you know, being a masseuse or you own a winery. Like, that just sounds really fun. Sitting behind a computer crunching numbers does not sound fun to somebody. I know it sounds fun for me, but it may not sound fun for everybody else. Understanding the business financing component is important. So understanding those 3 reports we talked about, having your cash flow and all of those statements for the last 3 years. And not only that, but understanding your own personal finances and assets as well. You can finance a building per se. Let's just say we want to purchase a shopping center, right? You want to purchase a shopping center, and in one of those businesses, you want to put yourself into it, right? Your business in it. You might be thinking that purchasing a shopping center is ridiculous. Like, Sarah, how would I ever do that? There's no way I can afford a shopping center. Well, guess what? Your business isn't what we're going to be looking at if you buy a shopping center. What we're going to be looking at is the cash flow of the shopping center. Some people don't even know that. They're like, what do you mean I can buy a commercial building and not have to make any money? That's correct. You don't have to make any money if you're buying a commercial building, so long as that commercial building is cash flowing. If that commercial building has, say, 3 small businesses in it, and it pays twice the mortgage 2 or 3 times, you can totally buy that place and stick yourself in that place. That financing is going to be very, very different than the financing for equipment. Financing for equipment, say you need a tractor, is not going to be that simple, right? Because the tractor is not going to cash flow. The tractor is not going to pay you money, and you can't make money on the tractor. That tractor is going to be used for is probably tilling the ground, probably, you know, moving boxes. It's not something that's going to add money to your business. It's just going to shorten probably the process or make something quicker, make you more efficient. So the lending on equipment is not the same as what we just discussed, like on a shopping center. So understanding that there are going to be different buckets depending on the type of financing that you want or the type of business that you have. If you have, say, a gun shop, that's going to be very different than right? You might not need equipment in a gun shop, but if you're a farmer, you're going to need financing for a tractor, maybe some land. They're all going to be very different. So I would rather answer the question specifically towards you. In general terms, the last 3 years and those 3 reports are the most important thing. But if you want to buy something specific, like a piece of property, it's going to be different financing. Okay, so I'll just let you guys ask those questions for you specifically if financing is something that you plan on doing. The question says trucking. Are you asking like financing for like an 18-wheeler? Yes. Okay. Let's talk one-on-one after, because it gets a little bit, it's considered an equipment loan, like a car or a truck like that. And so that's going to fall under a different category. So your business will need to cash flow. What are the do's and don'ts for small business financing? Invest your own money, earn the right to borrow, show profitability, all stuff we've talked about. Understand and keep working capital. What does that mean? Understand and keep working capital. What that means is kind of, I hate to say it this way, but cover your behind, right? Have some money on the side, have either a money market or a savings account, an emergency fund, just like we do for ourselves on the consumer side. It's really smart for your business to have that as well, to have some savings, and some folks like to say, well, my credit card's for emergencies. Well, I don't really believe in that philosophy. I believe your emergency fund is for emergencies and your credit card is for short-term lending. So your credit card is really for, say, less than a year, that you can pay that off in less than a year. That's my probably best advice that I can give you as it relates to using credit card debt or any sort of lined up short-term lending like that. The rates are going to be really high on a credit card, and I don't recommend keeping that balance for longer than a year. So if it costs you more than a year to purchase something and finance it, I definitely would consider alternatives for financing. Be lean on your fixed assets. Make sure that you have an understanding of your cash flow before you start taking on debt, because a lot of businesses took PPP loans. A lot of businesses took EIDL loans. A lot of businesses did. A lot of businesses are going to get audited. And a lot of businesses, I don't know if you read about this, but there was a realtor in San Diego who got quite a bit of money from PPP. And she paid herself, her family, and bought a Bentley. That is not okay. You will get audited and you will lose your business. You will probably lose your license, and she's actually probably going to jail. It's not worth it. Understanding your assets and be lean is smart. It's really, really smart. All the things that make you successful aren't really sexy and fun. They're boring and disciplined. They're clean vanilla, just by the book. Making money is not sexy. It's discipline. Do's and don'ts for small businesses. Understanding your financial statements, your collateral apps. We talked about this. Steps for getting ready for a loan. This is important. Have a business plan. How many of you have a business plan or do a business plan or review it every single year? I highly recommend that you have a business plan. It's really simple. You just go to Google and say, business plan template. Print it out, start writing. You'll really get a lot of ideas about your business, where you're at, how you want to grow, just by having a business plan. A banker will have a better understanding of where you're at in your business plan. The first thing that the sharks look at on Shark Tank is, let's look at your business plan. They don't show that on TV, but they do look at all the business plans up front. They want to know what you've done, where you're at, and where you're going. And the business plan does identify that for you. The business plan also may ask you some questions that you may not have thought about. Highly encourage you to do that. Just go to Google and type in business plan template, and you'll find something. Understanding what you can afford. If you don't know, you don't have to know. You can talk to a banker, and a banker will let you know what you can afford based on where you're at today and what the financial picture looks like today. Understand your financial statements, which you're all going to do because you're only going to spend 10 minutes a day doing it, and you're going to make sure all your information downloads from your checking accounts. Checking your credit report. I have an app on my phone that I check my credit report, and it's free, never paid for it. It's called Credit Karma. You can download it onto your phone, and it's really nice to use. And it gives you your FICO score. And when someone runs your credit, it's really good for fraud protection as well, because if someone runs your Credit Karma will give you an alert. Even your existing credit cards will run your credit. So if you have an existing credit card, they have the option to run your credit at any given time. So you want to see that, and you want to know when that's happening, especially if you're going through financing, because if you're trying to get a loan, you don't want other folks running your credit because it will reduce your FICO score. Check your credit report. Establish collateral options. Collateral options may be, do you own a home? Can you use your home as collateral? Do you own a car? Can you use your car as collateral? Do you have investments, stocks, bonds, and mutual funds? Can you use those as collateral? Any banker should be able to answer those questions for you. And it's going to depend on the asset that you're trying to buy, okay? Just like we discussed earlier, if you're trying to buy a shopping center, we're going to look at the shopping center assets and cash flow. If you're trying to buy equipment, we're going to look at your business and how that's cash flowing. Very different. So understanding your collateral options. Show your equity contribution. That line item refers back to the previous slide where we looked at the balance sheet. We're at the top where all the assets and then the liabilities below it. At the very bottom, it showed your equity contribution, which is how much equity you have in your business. Very similar to the equity in your home. and research your financing options. I think MCSC does a great job providing a lot of resources. So definitely check with them as far as your financing options, and use the folks that represent, right? Use Pacific Premier, use the banks that are there. I mean, use what's there, because all of that's at no cost. And most, if not all, the bankers have a slew of experience that can give you feedback to think about. Ultimately, you get to make the decision for your business, but it's good to have a conversation with a couple different banks just to get an idea of where you're at. And you might not realize, but they could spark an idea for you that could create a lot of options for you. So definitely take a look at financing options. Don't just stick. I mean, as much as I want to be selfish and say, stick with us, only talk to us, we want to make sure that we do what's best for you and your business. Okay. Common elements of a loan package. We discussed the business plan. We discussed the financial statements, current and historical. So your current statements, maybe year to date, last 12 months, and also the last 3 years. Personal financial statements. A personal financial statement is going to be something like your home. That's a personal asset. Your 401k, that's a personal asset. Your automobile, assuming it's not in the name of the business. And your personal and business tax returns. These are the key components of a business loan. So you want to make sure you have all of those things before you consider going and trucking and trying to get financing. Make sure you have all of these things in place and that you understand them, because a lot of the time, I didn't tell you this, but you can negotiate, right? And if you understand your business fully, you are better equipped to negotiate a loan. You're better equipped to negotiate rates. You're better equipped to negotiate underwriting guidelines when you understand your business fully. Can't stress that enough. We're about 4 minutes away from the 6 o'clock time. I'm going to end the PowerPoint here. It looks like we've talked a lot about this. Yeah, we did. So I'm going to open it up for questions. I know the cutoff time is 6 o'clock, but if you want to stay, I'm willing to stay and answer questions as well. Please go ahead and unmute yourself. No questions? I did a great job.
Stop it.
I did a great job.
You are just as awesome as you figured.
Come on. All that, no questions? Really?
Seriously, if anyone has any questions, please feel free to unmute your mics, or you could type them in the chat if you feel more comfortable that route. Okay, well, it looks like we are good to go.
I put my email in the chat. So if you decide you don't want to ask your question, or maybe your audio is not working properly, you can just send me an email at ssantana@ppbi.com and I can answer your question.